Shafat, should we start or should we wait a couple of minutes more?
I guess we can start. Up to you. You want to wait 1 minute more, or shall we start?
Okay, let's do 1 minute more to wait
Sounds
to see if there is more people joining, and then we start. Okay.
Sounds good.
Okay, so good morning, everyone in Malaysia. Good night in Minnesota, César, and people in DC. So tonight at the Kuala Lumpur World Bank Research Seminar, we have the honor to have César Sosa-Padilla. He is assistant professor at the University of Notre Dame, and currently he is a visiting scholar at the research department of the Federal Reserve Bank of Minneapolis. His research interests include international macro, international finance, macroeconomics, and fiscal policy. He received his PhD from the University of Maryland in 2012, and he will be presenting his paper the title of the paper is "Does it matter how central banks accumulate reserves? Evidence from sovereign spreads." So Cesar, thanks a lot for being here, and the floor is yours.
All right, thanks again for the invitation. It's a pleasure to be here, even though it's virtual. But yeah, I'm happy to hear what you guys have to say about the paper and what ideas you have for maybe improving what we're doing and making it more relevant. Okay, so I assume, we were trying before the live stream was started, so I assume you guys can still hear me well, and so if suddenly something happens, please let me know. Okay.
Yeah, and I forget to say that we have 1 hour, and if people want to ask questions, feel free to do it during the presentation, or you can just write in the chat. Okay?
Exactly. Yeah. I don't know if I'm going to be able to see the chat, but please just interrupt me, and
exactly.
I think that's just easier for everyone.
Perfect.
Okay. All right. So let me see. Okay. So this paper is a joint work with Federico Sturzenegger from Universidad de San Andrés and Harvard Kennedy, and I am César, as Agustin already said. My name is César Sosa-Padilla. I'm from the University of Notre Dame, and currently I'm visiting the Federal Reserve Bank of Minneapolis. So the usual disclaimer about the Fed and the Fed opinions are applied here. So these are just my views. Okay. And so the paper I'm gonna present today is about central bank accumulation of foreign reserves, and whether it matters how those reserves are financed. Okay. All right. Okay. So we start the paper from the motivation that there is a vast literature examining the benefits of reserve accumulation. Okay. And those benefits are essentially the different angles that the literature has highlighted can be roughly classified into 3 sort of pockets. The first pocket is that reserve accumulation brings about liquidity benefits. Okay, or the countries accumulate reserves in order to have a liquidity buffer for bad times. Okay? And that liquidity buffer helps the country smooth out shocks and sort of weather the crisis a bit better. The second sort of pocket of benefits that come from reserve accumulation has to do with hedging. Okay? The idea is that countries can invest can park these resources, its reserves, if you want, into investments that correlate negatively with their output. So they can get a better hedging, right? So during crisis, not only they have the money, but also those reserves are actually, sort of gaining. And the third sort of broad benefit of reserve accumulation is related to the mercantilist approach. And the idea is that countries accumulate reserves in order to be able to manipulate their exchange rate. Okay, and the idea is that countries have been accumulating reserves in the past decades in order to appreciate to avoid their currency from appreciating, and that has a mercantilist benefit in the sense that it can improve trade positions. Okay, so there's and maybe this sort of a simple characterization of the benefits of accumulating reserve is leaving aside some other important angles, like using reserves as a macro tool and whatnot. Okay? So our take is that the literature has been very active for a long time on analyzing the benefits, but we view as a sort of a surprising, in a sense, missing element the fact that there has been very little on the actual benefits of how we accumulate the system. So there's been much fewer attention being paid to whether those reserves are how are the countries paying for those reserves. Well, and that's sort of the gap that we're going to try to fill. Okay? In particular, we're going to, as I'm going to explain later on, again, at a broad level, there are three ways in which the country can afford or pay for these reserves. Right? One is by using external liabilities. Okay, that is sort of taking debt on say dollars, right? We more stark, just taking debt in a currency that it cannot print. The other is using domestic liabilities, that is peso debt or debt that it is somehow indexed to sort of the domestic income or the domestic economic condition. And the third sort of broad way is by using unsterilized purchases, basically just printing, just essentially with unsterilized money, right? Just, printing money and using that to buy the reserves. Okay. So we're gonna think about these three possible ways in the empirical application, but the general point is that this paper is gonna try to fill this gap that we see in the literature, that we see very little attention to the way that the reserves are financed. Okay, so that's sort of the angle for today. What we do exactly or precisely is essentially two things. So I'm going to have a theoretical part that I'm going to do first, and then an empirical part. Okay, so for the theoretical part, what we do is we provide a simple model of sovereign default, where the government or the country can have long-term debt, which we're going to allow sometimes to be state contingent, and can also have reserves. Okay? And this state contingency of the debt, I'm gonna later map into the data with when I think about local currency debt. So the result that we get from the data is that reserve accumulation using this contingent debt is associated to lower spreads. And the intuition comes because this contingent debt essentially gives you a break in bad times of nature, in bad states of nature. So in bad times, you essentially, in real terms, have to pay less, and therefore your probability of default goes down, which allows you to have lower spreads. So this result is not completely new, but we believe that our setup has some improvement over previous papers that had this qualitative result. So then we're going to, for example, this Alfaro and Kansuk paper I'm noting here on the slides. Then we're going to take this testable implication of the model that using state contingent debt decreases spreads. And then we're going to test this in a panel of countries, right? And what we're going to find is in line with this prediction. We're going to find that accumulating reserves, sorry, this says accumulating debt, but it should be accumulating reserves with domestic liabilities reduces spreads, whereas accumulating reserves with foreign debt or with external liabilities does not. Okay. And then we're gonna that we're gonna do in essentially running some cross-country fixed effect regressions. Okay. And to sort of to take care of some endogeneity concerns that one may have with that, we're also going to test the implications of the model by looking at exogenous events. We're going to look at exogenous large changes in the VIX index. And around those events, we're going to find that countries that build up their reserves using more foreign liabilities actually experience larger increases in their spreads, which is again consistent with the findings of the model, because we can sort of flip this around and say that countries that build up their foreign reserves using more domestic liabilities actually saw smaller increases in sovereign spread, which is essentially what the theoretical prediction is, that using domestic liabilities is a better way of financing the reserves. So that's the sort of the roadmap of where I'm going. And please, as Agustin said, feel free to stop me at any point. Okay, so as I said, the presentation is essentially in two parts. First, the theoretical part, and then the empirical application. So for the model, let me I'm gonna do the model in just a few slides. So let me first give you a sort of a broad view of what the elements of the model are and where we're introducing new stuff. Okay, so this is going to be a model of essentially reserve accumulation and sovereign debt. This sovereign debt is going to be defaultable, meaning that the country can walk away on the payments. And that sort of block, the sovereign debt block of the model, is going to be essentially an extension of what the literature has been doing, which is following the work of Eaton and Gersovic, again, Gopinath and Arellano, extending that model to have long-term debt and reserves, as I said. And the twist that we're going to do on this previous work, some of this previous work is mine, some of this is by other people. The twist is to allow for debt to be state contingent. Okay, and then, as I already said, when I map this into the data, I'm going to think of local currency debt as a form of state contingent.
Cesar, I have a question on this assumption.
Yeah, go ahead.
You allow either state contingent debt or non-state contingent debt, right? Correct. Other than simplicity, is there a reason for this assumption? I mean, for don't allow the possibility of having both instruments at the same time?
Yeah. So the main reason why we do this is for simplicity, as you said. If we allow for these two instruments, then you have to count these two, essentially, these two endogenous state variables on top of the reserves, which will be 3. Then the portfolio problem becomes too complicated. I'm not saying it's impossible to do, but it becomes very complicated. That's the short answer and also the true answer. we do it essentially for simplicity. But let me advertise a new paper that I have where what we do is like take this a bit further. The private sector of the economy, I mean, there's production in this other paper and other things. But this other stuff that I'm working with Francisco Roldan from the IMF is looking at allowing for the debt to be a fraction in dollars and a fraction in pesos, right? Or a fraction state contingent, like I'm gonna put it here. So in that sense, it's still gonna be one asset, but sort of the composition is going to be not 0-1 like I'm going to do it here. We're going to allow for something in between. I don't know if that helps. I mean, that is still a trick to keep the dimensionality of the problem low, but it's richer in the sense that it sort of goes towards the direction of what you wanted, I suppose. Does that make sense?
So I have
Yeah, go ahead.
okay. So I just have a other question about the. So I'm just trying to understand. So this, how so the story is about how central banks accumulate reserves, but how is it different from just the debt, just overall debt holdings and the composition of that, regardless of the purpose? So I couldn't make that link from going from the debt holdings and the type of it, the duration and the composition of it, going from that to the specific purpose of holding reserves and what.
Well, because it's not just about the sort of not just about the currency composition of the debt in a sense. It's about given it's about essentially it's that problem enlarged to include reserves, right? So the fact that you have the reserves, it affects the sort of the optimal composition of the how your debt, like it potentially changes the optimal way to sort of index your debt, how much of it is peso, how much of it is dollars or whatnot. But also the fact that you have this debt allows you to or incentivizes you to have more or less reserves. So I don't know if I'm answering the question correctly, but what I'm saying is that this is a portfolio problem that's larger than just sort of the currency composition of the debt. Okay, so that's on a theoretical level. Then when I map this to the data, I'm gonna try to understand how I'm gonna see that reserves have an effect on spreads. Okay, higher reserves decrease spreads, and then I'm gonna decompose that and say, well, the reserves can be accumulated. So reserves are assets. On the other side, you have liabilities. So the reserves can be accumulated with different liabilities. And which of these liabilities you use have a differential impact on spreads. That's the connection. I mean, there's a budget constraint that connects the assets and the liabilities. And I don't know that.
I see. Yeah, but my question was just about what. So you can raise debt to hold reserves, your assets, or you can raise debt to just distribute money, for example. Would it matter what the government is doing with that debt, for the debt composition of debt, or the other things of other factors of debt to matter?
No, for sure. I mean, I see your point better now. Now, for sure, the government, the only reason to accumulate debt is not it's the only issue to issue debt is not to accumulate reserves. You can issue debt for consumption, as you say, and that is going to be allowed in the model, for sure. Okay, so sorry. All right, so I was saying that I'm going to give you the broad sort of elements of the model. So the twist over, say, my previous paper with Yanchi or Yanchi Hachondo Martinez here, if you know this literature, the twist here is that we allow for debt to be state contingent in a particular way. So that's sort of a modification there. The rest of the model is pretty similar. Okay, so the economy is going to be an endowment economy that receives, sorry about that, receives an endowment Y, and that endowment Y is going to follow the Markov process. The objective of the government is going to be to maximize the utility of a representative agent, where the utility is going to be sort of standard. And to do this, the government has access to potentially two things: to long duration bonds that are going to be denoted by B, and these bonds, depending on the two formulations I'm going to show, we're going to allow them to be state contingent or non-state contingent. Okay, and the government not only can borrow in these bonds, but also can save in one period risk-free assets that are going to be denoted by A, and those A's are going to be the reserves. And all of these B and A are in units of the tradable group. Now, as I said, this is a model of sovereign debt, so defaults are a possibility. And what we're going to assume, again, for simplicity and following the literature, is that if the country decides to default, the default is going to be total. That means that the country is going to walk away on the payments that are due today and on the entire future, right? So if you have one period debt, then today is you only have payments due today. But if you have long-term debt, you have payments all over the future. So these defaults are defaults on everything. Now, if the country defaults, that is not for free. There's going to be a one period exclusion, the period of the default, which is just a parametric assumption. And then there's also going to be a utility loss. That utility loss is going to be captured by this function phi d. We're going to make that loss a function of the income. So by making it increasing in the income, so we're going to get that countries find it really, really painful to default in good times. Okay. All right, so all of that is about, in a sense, about the domestic economy or the small open economy that's borrowing from abroad. The people that are going to be lending are going to be these foreign lenders, which are going to be modeled in a very simple way to have risk aversion. Okay? So essentially what they're going to be is that they're going to be most of the time risk neutral, and then sometimes they're going to become risk averse. And when they become risk averse, they charge a risk premium on top of the whatever they were charging for the default rate. Okay, so those are the elements. I'm gonna move now to the following slide that has the equations behind it. Okay, so let me go directly to the asset structure. As I said, there are going to be essentially two assets: long-term bonds and reserves. So the bonds are going to pay a state contingent coupon. That's what I meant by state contingent debt. Okay, so a bond today, a bond that is sort of imagine I'm an investor and I buy a bond from say Argentina, which is my country. I buy a bond today in period T. Okay, that bond promises coupon payments starting in T+1 all over the future. Okay, so T+1, T+2, T+3, and so on. Okay, in each of these periods, the coupon that the bond promises is given by this equation here, the first equation of the slide. So the coupon in period T is going to be kappa, which is just a scaling constant, and these are in units of tradables. Okay, so it's going to be 1 unit of tradable, okay, plus phi, which is a parameter, times the difference between the income realization of that period and the mean income, which is y bar. Okay, so this is a simple way of modeling state contingent claims. What this is saying is that in good times, when income is above mean, the coupon is going to be larger, and in bad times, the coupon is going to be smaller. Okay, now if we take this parameter phi and make it equal to 0, then the model collapses to the model of Bianchi, Hachondo, Martinez in the ER. Okay, those are coupons that pay. I mean, those are bonds that pay a coupon in tradables, and that coupon decreases at the rate delta given by in this expression here. But for a given delta, the coupon is predetermined. Okay? Whereas if you make that larger than 0 or different from 0, then this thing becomes state contingent in this way, meaning that in good times the country has to pay more, and in bad times the country has to pay less. Okay, so the model exercise is going to be to solve the economy for phi equals 0, and then we're going to solve the economy for phi equals 1, and then I'm going to compare the two. Okay, of course, one can do many other things, like for example, look for the optimal phi. Which is not the sort of the point of this paper. In any case, this is the structure of the long bond. The long bond pays a coupon that depends on the income realization. But if imagine that we could fix the income realization at a given level, then the coupon is going to be decreasing because it's going to be sort of melting down. That's the trick to have long duration assets without increasing the dimensionality of the problem. This bond is going to trade at a price which is going to be endogenous, and that's going to be the most important price in the model. That's Q. Okay. All right. At the same time, the economy can save in risk-free one-period assets, which pay unconditionally or non-state contingent in a non-state contingent way. They pay 1 unit of consumption tomorrow, okay? And those are going to be the reserves. And the reserves are going to trade at the price QA. Now, this QA is also going to be it's going to be essentially the inverse of the world interest rate. All right. As I said, this country is going to be trading these bonds with the competitive foreign investors. These guys, there are going to be many of them, and they're going to be deep pocketed, okay? Meaning that they have unlimited amount of funds available to them. The only twist is that they're going to be subject to risk premium shocks. What that means is that we can think, we can think of their stochastic discount factor. That's going to be M. And that's going to depend on this exogenous state. The exogenous state of the economy is Y, the income of the borrowing country, and nu. And nu is going to be essentially a 1-0 variable that when it turns to 1, these guys become risk averse. Right? That's in a simplified way what's going on here. Okay, so having them being risk neutral is not essential for the qualitatives. So everything that I say holds with risk averse, but it helps in 2 ways. One is that it helps capture global factors that may affect spreads, and it also and therefore, since those global factors are in the data, having this feature in the model helps the model match the spreads better. So now that M function that I'm not showing on purpose, I have it here on a link, but I'm on purpose not showing it here, not to avoid derailing the conversation. This M function follows it's a very famous paper in finance, and has like a log normal shape, right? So what that means is that if we use that stochastic discount factor to price the short-term asset, it gives us what I just said, that the short-term asset, the price of the reserves is going to be essentially 1 over 1 plus R, or e to the minus R. So reserves are going to trade at this risk-free price. Now the bond price is going to have the usual property, right? So the price of a bond is going to be the expected discounted. So think of this M as the stochastic discount factor, so the stochastic beta, right? Is the expected discounted probability of repayment. That's the first term, 1 minus D prime. So D prime is the default decision of the country tomorrow. So 1 minus D prime is the repayment decision tomorrow. Okay. And if the country repays, then the investor gets the coupon, that is this fancy C, or this calligraphic C, the coupon of tomorrow, so that's C prime. Remember that the coupon of tomorrow depends on the realization of the state tomorrow. So C prime is a stochastic variable. And after getting the coupon, 1 minus delta of the bond is still alive, because it's a long duration bond. And that 1 minus delta of the bond is going to have a price, and that price is Q prime. Okay, so this is a functional equation where you have Q and Q prime. Okay, and we're going to iterate on this thing, and that's sort of the key equation of the model. How the price, what is the price of the sovereign debt? Okay. And then I'm going to make a big fuss about the spreads. The spreads are a transformation of these spreads. Okay. All right. So those are all the sort of the little parts. So now I'm gonna put everything in one slide. Right? So the problem that we're solving is this given by equation 1. Okay. What this is saying is a country that starts the period with debt B, reserves A, and the state of nature S. Remember that S is the combination of Y, the income, and whether the global shock is happening or not. Okay? So an economy with B debt, A reserves, and an exogenous state S has to decide whether to default or repay. So D is the default decision today, and it's only, as I already assumed, it's either 0, meaning full repay, or 1, full default. Okay, and the country is going to do whatever gives a higher utility. Okay, so for that we have to evaluate 2 things: the value of defaulting. So I'm going to call D sub 1 the value of defaulting, and D sub 0 the value of repay. where again 1 is associated with the D equals 1, so full default. So the value of defaulting is given by this flow payment. So it's the utility of the consumption in default. And the consumption in default is the income level plus the reserves that I had, because if I default, I keep the reserves, minus some government spending that I have to do, and minus whatever resources I use to keep accumulating reserves. So during default, the country keeps the reserves and can, if optimal, accumulate more reserves. So the consumption is whatever is left of that. Okay. The benefit of defaulting, obviously, is the debt that doesn't show up here in this consumption equation. Okay, so the debt went away. Right? The costs are 2, as I already said. B prime is also not here because the country cannot borrow. And the other cost is this phi function over here that it's we model for simplicity as a utility cost, but we can explain in the paper. It can be modeled as an income cost. If you have production, this is the production cost, and so on. So all of these are the flow payments. And then there's a continuation value. And since we only assume 1 period execution, then tomorrow the country is gonna start again in good standing, and it's gonna have 0 debt because we wiped out the debt completely, and the reserves that are chosen, and the state that realizes tomorrow. Okay, so that's the value of default. So the value of default, the problem is very simple. It's just choosing the optimal A prime. So it's essentially a consumption savings problem, and that's it. And the repay, the problem is more complicated because now there's a fully like a well-specified portfolio problem where the country has to choose not only consumption but also reserves and debt. Okay, and the resource constraint of the economy is this one given in equation 4 that says with your resources today, which is Y plus A plus whatever you borrow. Okay, so what you borrow is B prime, the debt. That B prime is the debt at the beginning of tomorrow, minus 1 minus delta B, that is what debt will be tomorrow if you issue nothing. So this thing in this parenthesis that I'm moving my mouse over, that is the issuance of debt today. So that issuance happens at a given price, which is an equilibrium object. So the price times the issuance, this is the debt revenue. Okay, so this is the auction revenue from going into the market. Okay, so these are all the resources, the income plus the auction revenue plus the reserves that I had at the beginning of the period. And I'm going to use that to do a bunch of things. Consume, pay this government spending, accumulate new reserves, that's A prime times QA, and to pay the debt coupon. So for each unit of debt that I had B, I have to pay a coupon that, remember, has the equation that follows the equation that I wrote before. It depends on the state. So in good times, the coupon is a bit larger. In bad times, the coupon is a bit smaller. So that's the problem that program solves. Okay, so what we're going to do is we're going to take this problem and solve it in the computer. Okay. All right. So we're going to calibrate this, and the calibration, there's essentially nothing new. We're not trying to think anything particularly surprising here. We're going to use Mexican data as sort of the guiding emerging economy to calibrate this economy too. It's going to be annual frequency, and we're going to take this sort of simple approach of defining our benchmark economy, the one with phi equals 0, meaning our benchmark economy is going to be the economy where the debt is not staying contiguous. Okay, so if you want to think of that as dollar debt, quote unquote, then that's going to be our benchmark. So making phi equal to 0 makes this model be exactly identical to the one in this paper at the AER. So we're going to follow their same calibration strategy. The utility function is sort of standard. As I already anticipated, the utility cost of defaulting is going to be increasing in income, and the income process follows an AR1. The income follows an AR1 process. So the calibration again, here there are a bunch of numbers, but this is identical to the calibration in the Bianchi Ochondo Martinez paper in the ER. The key parameters is 4 parameters at the bottom. These are parameters controlling the relative risk aversion of the representative agent, the 2 parameters that enter in the default cost, and a parameter that affects how risk averse these guys become when the global shock hits. Okay, so those 4 parameters are going to be calibrated to hit 4 moments. Okay? The 4 moments are these 4 moments here, right? So the debt level, the mean spread, the average increase in spread when the lenders become risk averse, so that's 2%, and the relative consumption volatility. Okay, so those 4 parameters are targeted to these 4 moments, and the benchmark model approximates them reasonably well. So this is identical to what you will find in this other paper that I was saying. Okay, so if we just look at the benchmark economy, this approximates relatively well the targets, and that's sort of a decent job, except for the volatility of the spreads in some important non-targeted moments. Okay, so crucially, an important non-targeted moment here is the level of reserves. Now we're going to grab this benchmark economy and compare it to the index debt economy. And there are potentially many definitions for the index debt economy. We're going to follow another paper by Roche and Roldan and make this the index debt, the one where phi is equal to 1. Okay, so any deviation from mean income, I'm gonna pay it or subtract it from the coupon. So if income is above mean income by 1%, then I'm going to give that 1% in the coupon. And if it's below, then I'm going to take that away from the coupon. Okay? And when we do that, so the last column is the solution for that economy. So we just change phi from 0 to 1, and we don't recalibrate. Okay? So potentially one could recalibrate here, and that is another also valid exercise. Okay? So we take this approach of sort of comparative static. We just move one thing and then try to make sense of the difference. So the take home here is that when the government uses this contingent debt, then it holds more debt, and it uses it to finance higher reserves. So the reserves are almost double here. Okay. So even though this country is having a substantially larger amount of debt, it only faces, on average, these are long-run moments, by the way. It only faces, on average, a slightly higher average spread. Okay, and that is because it has more reserves and because the coupon payments are continuing. The portfolio that comes out of this, which is essentially reserves to debt roughly 20%, it's in line with the data, and it's a substantial improvement over a related paper by Alfaro and Council.
Cesar, I have a question on this. I'm a little bit confused about why you didn't recalibrate the model to make these economies comparable.
That's right. So that's an alternative that's a valid exercise to recalibrate the economy, to recalibrate the model. I'm more than, in fact, what I want to say is that more than just looking at these long-run moments, what I'm more interested in is what the next slide is going to show you, which is for a given debt level, what's the spread menu that you face? Okay, so that is not the same as recalibrating for the same debt, for the same average debt. So in a sense, I want to control for the debt level. Okay, one way of doing that is by recalibrating and saying the two economies are going to have the same debt level. The other way of doing that is what we did, which is to look at this graph and say, well, for a given debt level, using the index debt gives you lower spreads. Right? So in a sense, I am concerned about what you are concerned, which is that the debt level matters here. Right? It's just that we decided to take this approach. I think there is anything wrong in recalibrating that could be done.
For example, if you this same exercise, but instead of spreads, you plot the reserves level, you also find a higher level of reserves for a given level of debt in the index debt economy.
I think so. Yeah.
Okay.
Okay. So as I was also about to say, from this model, we want to take this testable implication, okay, which is for a given level of debt, financing the reserve accumulation with contingent debt or with index debt allows the country to pay lower spreads. Okay? So this is the testable implication we're gonna take to the data. Okay? So how are we gonna do this in the data? As I anticipated, we're gonna follow essentially two approaches. One is a fixed effect regression, and the other one is looking at exogenous events. I mean, if you're happy with the fixed effect regression, then I'm happy, and then we can end there. But some people were not that happy, and then we look at some exogenous events, sort of to appease some concerns about endogeneity. Right? As a preview, let me tell you that the results are consistent with the model in the sense that from the model, I want to take away two things. One is that the way that reserves are financed, or the way that reserves are bought, matters. And the second is that using contingent debt helps reducing the spread, whereas using foreign debt doesn't, for a given level of debt. Okay. So, sort of as a warm-up exercise, we're gonna sort of redo some regressions in a previous paper, and we're gonna show that holding debt and other controls constant, or controlling for debt and other covariates, higher reserves are associated with lower spreads. Okay, so this is standard. So in particular, we are extending by including other countries, but keeping their same specification, extending this paper by Levy, Yajati, and Gomez. Right, and we got some, not all, but some of the data from them. So here the dependent variable is the log spread, and we have this sort of standard specification where we have reserves, the ratings, the level of sovereign debt, the level of private debts, some measure of risk aversion, war interest rate, and okay. And whether we control for country fixed effects or not, what we find is, I mean, what they find, and we sort of find again in our modified data set, is that higher reserve ratios are associated with lower spreads. Okay, so this is not surprising in a sense. We are gonna what we wanna do is sort of zoom into this reserve ratio and decompose it using the balance sheet. Okay, so what we're gonna do is we're gonna make use of this great IMF data that provides us with a sort of harmonized data set of central bank balance sheets. Okay, so they put together data for many countries, and the central bank balance sheet is essentially you have access to the central bank balance sheet that looks like this. It has all these components. Okay, so on the asset side, you have claims on non-residents, that will be reserves, claims on other depository corporations, and net claims on the government. And then mostly on the liability side is pretty rich. You have liabilities to non-residents, the money base, and other stuff, including loans and financial derivatives and other things that are essentially domestic currency debt. Okay? So this is very rich, and the data set is available from the IMF. What we're going to do is we're going to grab this sort of complicated object and summarize it in this way. So we're going to have a simplified central bank balance sheet, okay, where all these components, so I'm making reference to this previous slide here. So one is this, claims on non-residents. So claim on non-residents are the reserve ratio. External liabilities are A, so A is liabilities to non-residents. Then we're going to put together C, D, E, and F. Those are other liabilities, deposits, loans, and financial derivatives. All of those we're going to call remunerated domestic liabilities. Okay. And then B, which is money, those are unsterilized purchases. And then every other component of this balance sheet we're gonna put together and call it other balance sheet components. Okay, so we take this sort of original balance sheet as it's available from the IMF, and then collapse it into this simplified balance sheet where I just have the reserves, on the left-hand side, and I have external liabilities, domestic liabilities, money if you want, or unsterilized purchases, and others. Right? And the point of our identification will be that we're gonna keep the reserve ratio in the regressions as I had them before, and then put the elements of the liability components. Okay, I'm gonna put 3 out of the 4, and the idea is that the one that I leave as the one that I leave out is the one that is moving, right? So I'm gonna interpret that regression as reserves financed by, say, external liabilities or domestic liabilities. Okay, so that's what I do in this regression. Okay, so for example, this numbers, the numbering of the columns corresponds to the paper. Sorry about that. So in column 6, what I do is, first of all, each of these columns includes all the other controls that I had before. I'm just not showing them to show what I want to show. Okay, I'm interested in the reserve ratio coefficient, and I'm including the reserves. I'm also including domestic liabilities, money, others balance sheet, and I'm excluding external liabilities. So I'm going to interpret these as reserves that are financed with external liabilities. Okay, that's the sort of the how we're identifying the effect of reserves that are financed by external liabilities. In the second column, or in column number 7, I'm going to do the same, but I'm going to leave out domestic liabilities. So I'm going to interpret that as the effect of reserve ratios of reserves on the spread when the reserves are financed with domestic liabilities. And the third column is when they're financed with unsterilized money. The takeaway from here is that the way you finance reserves matters, right? And in particular, we see that. Let me just move to the next slide. So in this slide 16, I'm just going to take these 3 coefficients at the top, which is what I'm interested about. Okay, when reserves are financed using EL, meaning external liabilities, they have essentially a non-significant effect on the spread. Whereas when they are financed with domestic liabilities or with money, they have a significant effect on and with the sign that we expect, that meaning that they decrease the spread. Okay, so the take-home message here is that how we finance these reserves matters, and that the accumulation with domestic liabilities, which I'm as I already said many times already, I'm going to map that to the contingent liabilities in the model. Financing the reserves with those help reduce the spread, while using foreign liabilities or external liabilities does not. And that is consistent with the prediction that I had from the model. Okay. All right. So this is sort of our headline empirical result. This result is robust to a number of modifications. Our theory also tells us that these benefits of using contingent debt for domestic liabilities is higher, it's more pronounced, the higher the debt is or the higher the spread is. That was in the plot. Okay, and that is also consistent with the data. So in this table that I have now here, the top panel is one in which I split the sample into high debt and low debt countries. Right? And what I see is that in high debt countries, accumulating reserves with domestic liabilities, that will be this coefficient, that has a negative effect on spreads, meaning it's favorable for the country, whereas doing it with external liabilities is not. This difference that I highlighted on the average before sort of disappears in the low debt, right? So it's not that prevalent in the low debt. A similar thing can be said about the high spread, low spread split. Okay? So the fact that this using contingent debt is particularly good in bad times, that is a feature of the model, and it's also found in the data. And this point of splitting between high debt, low debt, or high spread, low spread holds more generally, and the use of contingent debt is mostly beneficial in these 3 scenarios. So this holds for things that are absent from the model, but that they're certainly important in the data, like splitting the sample by devaluation rate, fiscal deficit, or the degree of polarization. And I'm on purpose not going to read through this provision. Okay, but the idea is, again, that the point that we were making before, using state contingent debt is beneficial in the sense that it reduces spreads. That is particularly true in these stress scenarios. All right. So those final regressions you may have endogeneity concerns about them, even if we are controlling by all these covariates and also including country and time fixed effects. Okay. So what we're going to do next is to make use of global shocks that are clearly exogenous to the countries under study, and show that in these scenarios of these global shocks, we still find this pattern that countries that use mostly domestic debt to finance the reserves face lower spreads. Okay, so we're going to borrow from the work of Alain Rey and Acharya and Krishnamurti. This focus on sharp increases in the VIX. Okay, and we're going to identify events in the following way. So it's going to be any date in which the increase in the VIX is larger than 20 points. Okay, and that is with respect to an average value of the VIX in a window of the prior 5 to 10 days. So if the VIX spikes today, then I'm going to look at what the VIX was in the window between T-5 and T-10, and that's going to be my reference value. And if today the increase is more than 20 points versus vis-a-vis that value, then I'm gonna that's the first sort of criteria. And the second criteria is that on that period, the average increase in spreads is at least 10 basis points. Okay, so 10 basis points is very small, so that is not very stringent, right? So when you have when these two criteria are met, that the VIX has a non-trivial increase and the spreads also have a non-trivial increase, then I'm going to call that an exogenous event. Okay. So just to clarify, we have the data from 2009 to 2020 essentially, and we ran this. This is essentially an algorithm, right, to identify dates. We ran that, and that gives us 3 dates, and the 3 dates are the vertical lines, the vertical dashed lines here. Okay, so let me tell you what these dates are. So one is May 7, 2010. That coincides with the flash crash in the US stock market, the previous day, May 6. Okay, so that is completely exogenous to the emerging economies we have in our panel. Right. The second date is August 8, 2011. This was called the Black Monday of 2011, when the S&P downgraded the US debt. Okay, so it was in the middle of the global financial crisis. And August 24, 2015, which is another so-called flash crash of the US stock market. Okay, so this is very reassuring that we ran this sort of identification algorithm for the exogenous episodes. We get 3 of them. These 3 are clearly exogenous to the countries we're analyzing. Okay? So now we're going to look at how different countries, what happened to the spread of these countries in these 3 dates. We're going to put the data for the 3 events together and see what happened. Okay. Well, and what I'm plotting here is what's the spread variation, so the change in the spread as a fraction of how much domestic liabilities these countries had, and I'm going to plot that also against the fraction of external liabilities that these countries had. Okay. And the punchline here, or what we want to make the punchline, is that the more a country finances its reserves with domestic liabilities, the smaller the increase in spreads. Okay. Or if you want to put the other way, the more the country finances its domestic liabilities, the more the country finances its reserves with external liabilities, the higher the increase in the spreads around these exogenous events. Now, this is just a test of statistical difference between these coefficients, and these are statistically different, as you would expect. And this calls for this in general calls for the pool sample. The pool means all the data for the 3 events together, and also event by event. Okay. So maybe I'm ending like 4 minutes before or something, but essentially what we're trying to do here is what we wanted to do is we want to show that the way that the reserve accumulation is financed matters. The focus of the paper is on the effect that has on sovereign spreads. But clearly, this goes beyond sovereign spread. I mean, there's no reason why you should just focus on sovereign spreads. This could affect other things, like sudden stops, for example. Our sort of expertise is on sovereign spreads. So we decided to first look at that. We find that accumulation with dollar debt, if you want quote unquote dollar, with debt that is non-secontingent, in the way we model the secontingency. So with non-secontingent debt, this debt provides liquidity for sure, but also has no hedge. On the other hand, domestic debt, either indexed to domestic outcomes or in local currency debt, provides both. And this has a differential impact on the default incentives and therefore on the spreads. The model has testable implications that hold in the data, and I've shown that it holds in the panel regression and also holds in this sort of event analysis around exogenous shocks to the VAS. Our sort of policy line to end the paper is that taken from the what we learned with this model and what we find in the data is that we think that reserve build-out programs that are typically pushed by not pushed, but typically recommended by the IMF and other institutions should rely more on the use of contingent debt as a financing tool. And that's it.
Thanks a lot, Cesar. So we still have like 2 minutes if there is any question, and please, there's gonna be like a survey in the chat. So please, the audience, if you can help us filling the survey, will be great. And Shafat, you have a question, right? So go ahead.
Hi, so great presentation. Thank you very much. Very clear. And so I just have one question. So I understand that you're saying that the effect of reserve accumulation, the spread reducing effect of reserve accumulation depends on how you're raising those reserves.
Correct.
But for the total, so I also understand that these state contingent bonds naturally have higher spreads overall. So there's two effects, right? So there's one that there's a marginal effect, and there's this total effect, which depends on the compositional shift from going from low spread debt to high spread debt or high interest rate debt. It would be interesting to see which one dominates.
Yeah, I agree with you. This is a very good point. So let me go back. I don't know. Sometimes it's unsettling for the eyes when you move the slides very fast. But the point, what you're saying is that if I did what Agustin wanted to do, right here, I would miss, at least from the table, I would miss the point. So here not recalibrating helps me capture exactly what you're saying, right? So the total effect here, the spread is larger with index debt, okay? Right? But then I'm making this point that for a given level of debt, and in particular for the level of debt that I see in the simulation, having the index debt is better in terms of I face better spreads. So I interpret this as the marginal effect and what happens on the average is sort of the total effect that you say. So that mapping may be a bit loose, but I think it's sort of on the right track. Okay, so that's sort of re-asking your question, right? So I haven't really answered. To answer, I guess one will need to do like a serious welfare exercise, right? Where I give a fair chance to both models, and essentially the planner can choose, or the government can choose the preferred effect. right? Whether you are okay with paying a bit on average, paying a bit more of spread, but having this contingency at bad times.
Yeah,
I think that essentially I can recast that question into what is the, I mean, to think about something that's doable and not a big mess. What is the ex ante optimal value for that file, for example?
I see. Yeah.
Okay, so I mean we are running out of time. So thanks a lot, Cesar. It's such a cool paper. I really enjoy it. I have still a couple of questions, but maybe I can talk to you in private. And thanks a lot for everyone for coming.
All right. Well, thanks guys.
Thank you, Cesar.
So are we still live on YouTube?
I'm not.
We can
probably are.
We can now end that. I'll ask Steven to end the live streaming on YouTube. Actually, we got quite a few. Actually, the participation in YouTube was much larger than here.
Oh, really?
That's yeah. It was around 30 people there.
Do we have questions on YouTube? No.
Yeah, I didn't see any, but
Cesar, I have another meeting right now, so I have to leave. But maybe I can just write you an email, or maybe we can talk later. Is that okay?
Yeah, no problem. That works.
Perfect. Thanks a lot for accept the invitation.
Oh yeah, thanks to you guys for inviting me. Bye.
See you, and thank you, Shafat.
Yep.
Thank
Great
you, everybody.
presentation. Thank you very much, César.
All right. Well, good to see you, and take care.
Bye.
Bye. Oh, I have to. Oh, I was still sharing my screen. Okay. Bye.